All right, looks like we have slowed down in terms of the number of folks joining. So I would like to welcome you to our third quarter update call. For those who don't know me, I'm Jennifer Klein, Head of Wealth Management here at Cambridge Trust. I hope that everybody's staying cool. I know I'm certainly happy to see the temperature be below 80 today, and hope everybody's enjoying the summer. I'd also like to welcome some of our Northmark colleagues to the call. You may all know that we've agreed to merge with Northmark, a bank with offices in North Andover and over in Winchester. We're all enjoying getting to know each other, and we're excited to formally join forces sometime in the fourth quarter of this year. I'd also like to remind you that we are recording this call and we will post it on our website in the next few days. Also, please feel free to add questions that you may have as we go along in the Q&A session. Today, I'm joined by two of my colleagues, Dave Lynch, Chief Investment Officer, and Stieg Zarl, Senior Portfolio Manager and co-manager of our SRI strategy. Stieg is also an analyst covering a number of sectors in the equity markets. Dave will give us an overview of the markets and our current positioning, and Stieg will give us a more granular view on what's going on with companies and their earnings. Our last call focused on inflation and interest rates. Since then, the Fed has raised rates twice for a total of 150 basis points. Today's CPI release shows that inflation has fallen somewhat, but not a significant amount, to about 8.5%. Down from last month's high of 9.1%. So one thing that I'm certainly noticing, and I assume you all are as well, is prices at the gas pump are significantly lower, and I think we all appreciate that. Our presentation will go for about 25 to 30 minutes, and then we'll take your questions. Please do ask questions in the Q&A part of the screen. So with that, I will turn it over to Dave Lynch for the overview. Dave.
All right, good afternoon, everyone. Happy to be having this call on a slightly happier day for the markets. Markets were buoyed by the softer inflation report that Jennifer just referenced. We'll talk a little bit more of that as we dive in. What I'm going to do is go through a few high-level slides on the economy and our outlook, and then we will culminate with boiling it down to where our current positioning stands and why it stands there. So let's move into the slides, and Michelle, if you could take us to slide 3, I'd appreciate it. So this framework, this is a framework maintained by our friends at Fidelity. It just talks about the global business cycle and where respective regions are. You'll see the US in the green olive circle there, by their estimation in late cycle. I know there's a lot of debate out there right now whether we are in fact already in recession or headed towards one or not, but we are at least that far along, perhaps even a little further. But noting by their definitions there in the upper right on the slide, late cycle is characterized by growth moderating, whereas recession would be outright falling of activity. We've seen some of that in GDP numbers with the negative contraction last 2 quarters. However, there's obviously a lot of other parts of the economy that are powering right along, most notably the jobs market. Credit has tightened, but it has not dried up in the way it might in a recession. Our earnings are under pressure, characteristic of late cycle, but are not really outright declining yet, although we do have some caution and nervousness around that possibility, which we'll talk about later, and Steve will get into it in far greater detail. Inventories have grown. We've starting to get plagued by some inventory mismatches, overshooting, undershooting, et cetera. And we'll get more into that as we go forward. But so we're in that gray area between that late cycle and some of the more outright recessionary indicators. We here at Cambridge Trust largely leave that debate to the academic economists. It really doesn't change our outlook and our way of investing, whether we are quote unquote in a recession or not. For all intents and purposes, we're in a slowdown. We're expecting a further slowdown, and that is the guise under which we invest. And similarly, you're hearing a lot of of lingo about hard landing or soft landing. Those are, matters of degree. Our stance has been, it will be a bumpy landing. There'll be some mismatches, some of this overshooting and undershooting, needing to clear supply chains or dump excess inventory. In fact, some demand waning away, et cetera. So there'll be this sort of rearranging of things that will likely be bumpy, but whether we call it hard or soft, again, is not necessarily central to how we will choose to invest. Onward to the next page, I'm looking at the equity markets. And so this is a longer term window dating back to 2012, just a 10-year window. And it is meant to provide some contrast, that though you can see in the circle there, dotted circle in the upper right, it's been a very volatile time. The market has drawn down substantially this year, has made some recovery here recently. But in the grand scope of history, some of that does blend away, and that equities for the long term do tend to maintain their upward trajectory. And so, that's, though we agonize a lot about the short-term movements, it's really trying to capture the longer-term trends that are important to us. And you'll see there in the lower portion of this page, that is the forward price to earnings ratio, a measure of valuation. You'll see it's more in kind of a moderate place. It's maybe no longer outright expensive as it got during some of 2020 and 2021, but it's probably not extremely cheap either, as it has in prior crises. So somewhere in the middle ground, and that's about where our stance is in portfolios. So moving forward then to the next slide. We are a little nervous about earnings, and obviously there's many indicators that you can use pro and con around that, but this is one example of some of the economic leading indicators are saying that the upcoming earnings forecasts may need to be trimmed further, and then the ultimate realizations are likely to come in a little bit softer. And so we do have some caution around the overall market. Our analysts are still finding a lot of individual opportunities. The market as a whole, it has probably a little more reckoning to do, which in lowering some of the earnings forecasts. And earnings will probably be bumpy around, even if in some respects they may be favorable in certain times. But input costs, by and large, are higher as is sort of intuitive by what's going on with inflation, and that eventually will crimp profit margins. And so higher wages and labor being harder to find and harder to retain is another form of margin pressure for most corporations. And then adding to this is some of the inventory mismatching that we've talked about. And it's come in a couple of examples that you have probably heard about on the news, is what's going on. It come to light in the semiconductor industry in only the last few days here, between Micron and NVIDIA and others warning about some softness in demand for their chips. And so there are certain types of chips, particularly those for the auto industry, that are still pretty hard to get, hard to come by. But it was sort of an ironic place for profit warnings to come, because all we've been hearing about is we'll never find enough microchips and never find enough microchips. Well, in fact, some of what was an impossibility to source turned to hoarding and over ordering. And now at the other end of that rainbow is sort of the dumping and the removal of demand. And so we've seen that happen. Similarly, kind of a different, further afield, dating back a few weeks, Target and some of the other big box retailers have had problems with their inventory management and overshooting, having more patio furniture and home improvement goods than the consumer any longer wants after bulking up during COVID. You don't need a new patio set anymore, or you might have waited forever for that sofa or that TV, but you probably don't need a new one anytime soon. And so some of that pull forward of demand is going to create a bumpiness for earnings as well. Moving on then one slide further, it's certainly been a lively and active stock market to be a participant and an investor in. This graphic, perhaps a little bit hard to see on the font, but what it is saying is that 89% of the market days this year, the market has moved by greater than 1% during the day. It could be an up day as well. Up days count. but either up or down 1% within a day across that degree of range is relatively rare for that to happen nearly every day. Haven't really seen a stretch like that since some of the subprime euphoria, and more likely the woes after the subprime bubble bursting. And similarly, you'll see it there in around the 2000s in the run up to the dot-com bubble, and then the bursting thereafter made for very volatile stock markets, and we'll certainly are seeing that this year. So moving one slide forward, our unique characteristic here, though, is that though the equity market has been extremely volatile and grabbing a lot of headlines, in the context of where volatility went during the onset of COVID, here on the left side of this page, you'll see all markets spiking in volatility, appropriately so, of course, given the pandemic outbreak. Bonds, FX, foreign exchange, currencies, and equities. But though equities are volatile, they have settled down somewhat from where they went to briefly during COVID onset. But the bond market is as high, nearly as high as it was during that time, because so much of the focal point right now is around what is the Fed going to do and what is inflation going to do, and that's sort of dictating nearly everything about the world lately. And so the bond market is sometimes renowned for its stability and quiet and at times sleepiness, but it's been extremely volatile and there as well. So onward to the next page, and the Treasury bond yield curve, and a few things to talk about in this curve. You'll see the top line, the green line, is where we are currently. The snapshot was taken a little bit earlier today, so it has some of the movement post today's inflation report in it. The lower line is where we ended last year or began this year, 12/31. And you'll see it was a more normal upwardly sloping shape to start the year, but it has become an inverted curve, and certainly an abnormally shaped curve, given all of the action of rates and inflation in the Federal Reserve, as well as the concurrent recession outlook around that in the longer dated horizon. The bars, the yellow bars, gold bars at the bottom are the degree of movement in each point on that curve. And you'll see all that action is in the front end primarily. That's where the rate hikes live, most notably. And it's created that inversion. The inversion appears a little bit subtle on this page, but is actually quite profound to be in the 40 to 50 basis point range in the 2 to 10 year. And so, this has created a few different dynamics. An inversion of this degree tends to preview and predict a recession upcoming. It's not necessarily the cause of it, but it is often just a concurrent indicator of what might be on the horizon. I think in large part it is saying that the Federal Reserve has more hiking to do in the front end to get control of inflation, try to break the back of inflation, but in some respects may have to do that at the expense of the economy and recession. And so we'll get inflation back under control one way or another. But the reason you don't see the 10-year much higher is because if we do go into a recession, some of that safe haven of bonds and a 10-year rate around 270 could be attractive and a safe haven of sorts. And it also says that the inflation hopefully would not persist over that long of a time period. So also a settling back down. Eventually the Fed will go back to a cutting cycle. The market is already looking out that far, though it doesn't always seem that way. And so that hump in the front end would go back to something more normal in terms of slope. One silver lining of some of the things that this has caused is cash rates are now back to something more attractive and more palatable. The opportunity cost for being in cash is no longer, zero income and yield earned. It's somewhere between 1% and 3%, depending on what type of cash instruments we're using. And so, that's offering a place to do some parking of assets, managing of risk in the front end of the curve again. It also you don't have to go so far out the curve to earn those 3+% yields. So that is one of the good things of what is playing out. So onward then to the next page. This is just solely the 10-year bond by itself, which is the bellwether of the market. And you can see that run up in the first half of the year as inflation was really rampant. Market was coming to grips with what was spiking commodity prices, Ukraine invasion, et cetera. And it was a terrible first half of the year, very, as I put in the title here, very harsh first half of the year for the bond market. Though some of that has moderated and reversed here, bonds and stocks have had nice positive returns quarter to date. So since June 30th, you'll see the hook and the reversal there in the 10-year on this graph. And the fear here is again what I was alluding to earlier, that in worrisome days for bonds, it's that and the market, it's that the Fed might have to, in so many words, self-inflict a recession in order to get inflation under control. They'd rather not have to do that, but all else equal, beating inflation is the #1 priority. And if that means almost a deliberate overshooting of their rate hiking, they've run out of time to wait for inflation to be transitory as they formerly were, and they have to get in the business of trying to, in fact, destroy some demand. Supply channels and supply availability has not come up to meet demand as they had hoped, or demand has not waned of its own sort of fruition. So they're looking to do things like effectively destroy some of the job openings. They hope not to destroy any of the existing employment and stop before it would get to that place. But maybe the number, hundreds of thousands of jobs that are out there, maybe have some of those job postings come down because of tighter financial conditions. Next to page 10, just a few more slides to go here. So credit risk, and I think that what is this, one of the distinguishing factors of the current environment is that credit markets remain relatively orderly. So in the case of subprime, for example, where there was a fundamentally overstretched and broken credit market and mortgage market in that instance, things are, the system itself is in a more orderly place right now, so far anyway. And though credit spreads here, the blue line being high yield and the red line being investment grade corporate bonds, both of those have crept wider, which is good and offers some opportunity for better reinvestment yields and opportunities within bonds, but has not gotten as far as it got in the onset of COVID, which is the spike that you see on the page. But even this page is somewhat of an optical illusion in that, for example, that blue line that is during the COVID onset got to 1,000 basis points over equivalent treasuries, or 10%, got to over 2,000 basis points in 2008, 2009. So should we get to levels out in those areas, we would be looking to step in and buy, and certainly have the dry powder to do so. So happy with some of the wider spreads, but they're still not screamingly cheap to really load up right now. Next slide, and this will sort of bring us, I think, in for a conclusion on the sort of interest rate segment of the presentation here is the challenge here is that in most cases, the Fed doesn't or can't, depending on your perspective, stop raising rates until they have the Fed funds rate above the rate of inflation. And so right now, there's still quite a large gap. This chart is slightly, is one CPI print back. So today, that 9.1 in the red bar that you see did move into the upper 8s, but there's still basically a 6% gap. And so we need a combination of inflation coming down and the Fed coming up to kind of meet that. It's not necessarily a mathematical requirement that the blue line gets larger than the red line before the inflation hiking cycle is over, but nonetheless, it seems early to be predicting the end of things. You know, the market today is happy that the Fed might not have to hike rates as aggressively. Maybe that 75 basis points at their September meeting becomes 50, or maybe some of the rate hikes further out the calendar become a little smaller or taper off a little more quickly. Nonetheless, though, and I think this is some of the kind of reality that we have to face and wake up to, there's still more rate hikes to come, and materially more rate hikes to come, even under the best of scenarios. In that sort of don't fight the Fed notion, net liquidity is being drained from the system, financial conditions are being tightened. So this not even to mention the quantitative tightening program of them running off their balance sheet in some of the bonds that they bought to help support rates in the market during the worst of COVID. So on to the next page. We all know that a lot of things are pretty darn expensive, and the shift to from goods to services, things like flights and hotels and those things are still quite expensive. There are some things moderating. Obviously, there are some things moderating in the inflation report this morning, but mortgage rates have gone higher. And the question is, will that drain some of the housing demand and help to kind of cool that market off a little bit? Unfortunately, makes housing less affordable with higher mortgage rates, but also does take some of the demand and the euphoria out of markets. Rates have come back down a little bit from the peak they got to a couple of weeks back, but are still certainly well off of their lows. And the next page, as Jennifer alluded to earlier, we've also seen gasoline prices turn around and begin falling. Again, still relatively elevated. We still have a lot of unknowns to face in energy markets and agriculture markets, for that matter. On the geopolitical front, I think it's going to be a very trying winter in Europe with Russia and all the pipeline shenanigans that they have been pulling and can pull, particularly as winter sets in. We're about to head into hurricane season. We don't know what that will do to energy or crop yields. So there are some wild cards out there to still be watched, but some of these things are softening. And I think it's a little bit semantic, but we are probably past peak inflation, though it's still quite steamy inflation nonetheless. And so then my last page here to bring us in for a landing on my section is just making some of a distinction between the different types of market maneuvers that we consider and discuss and debate as a team, and those that we may choose to pursue versus those that we may choose to avoid or kind of sit out in favor of larger themes and larger investment opportunities, and the difficulty of timing the market in the short term. You'll see the jagged lines here, that small, thin, I guess, yellow line of tactical, the shortest of short-term moves in the market. Those are very, jagged, sudden, hard to predict, hard to capture. If we have good conviction and confidence that we can capture them, of course, we're out there capturing them for our clients, but it is not sort of an everyday habit that we're trying to be in the market every day, making big swings of portfolios. Our foundation and bedrock is that longer term buy and hold opportunities. So our focus is more on the more gently sloped and squiggly lines there, the business cycle type of trends that can take 1 to 10 years, or even the more secular longer term trends, 10 to 30 years. So things like secular might include some of the research that our equity and bond analysts are doing on electric vehicle transition, electrification, carbon, stepping aside from carbon and moving towards electricity. That's not an immediate thing, but it is one of those secular multi-decade type of things that if we pick the right investments, we can be patient with them to play out in these sort of longer term curves, all the while trying to have the portfolio be pretty robust across, as listed on the bottom here, asset classes, countries, regions, sectors, and respecting kind of the intracorrelation of different asset classes and different exposures. And so I think with that, Michelle, you could probably stop the screen sharing, and I'll just wrap it up with our current positioning in portfolios. I've alluded to a lot of it through my comments, but I'll wrap it up. In our equity positioning, we did move to a slight underweight last week. I'm still sort of finishing the trading up on that early this week. This is not a hide under the mattress adjustment to our equity position. It's a risk management adjustment. As we talked about, I think earnings optimism is still a bit high. The Fed is still tightening, even though potentially slightly less aggressively so. Nonetheless, still tightening conditions. we still have individual opinions and convictions on our individual stocks for many of our strategies, and then GAA and our mutual fund strategies are expressing it more on sector type bases. But the comprehensive strategies, which is the bulk of our client base, we are still excited about individual opportunities. It's just a bit of nervousness about the market collective overall. In commodities, we closed our commodities position at the end of July. It was a pretty successful run, and in some respects, the way you might talk about a stock, it's as though the commodities market hit our price target probably sooner than we expected. No complaint that it had such a rapid rally and was supportive of portfolios in what was an otherwise challenging time for stocks and bonds. However, with the prospect of recession growing, kind of some of this demand destruction we're talking about, we decided to step aside from commodities for the moment. We do think there are secular trends, both in kind of traditional commodities as well as alternative investments for the longer term. But given the current short-term dynamics and price rally and some of the overbought stretched conditions, we decided to moderate our risk in that bucket. That is not to say that we have, we still have a lot of investments in energy and materials and other things within our equity and bond portfolios, because we think, say, for example, even if oil comes down by $20, that would be a hit to the price of oil and the commodities futures of oil. But many companies would still be extremely profitable at those levels. And so we choosing to participate through equities or bonds in some of these themes, rather than being kind of exposed to the shorter term price fluctuations on the front end of futures curves. In fixed income, we are still slightly underweight fixed income. We have added to some, and fortunately so, given that hook and improvement in rally in bonds in the 10-year that we saw earlier in this presentation. But what keeps us from being fully invested is that the credit portion of the bond market is still not overly attractive. It is not poorly priced, but it is not attractive to really be all the way back to market weight or beyond in fixed income. So we're keeping some dry powder for when the time is right to do that. We are pleased with some of the better reinvestment rates in portfolio strategies where we're holding bonds to maturity and reinvesting at better opportunities. So there are silver linings to where the bond market is going. And then cash, we are overweight cash currently. Some of that is strategic, in that having some of this dry powder, some of this buffer to our other equity and bond risks is appropriate. There's not as much opportunity cost right now to being in cash, as was discussed, at 1% to 3% type of yields in cash and short-term enhanced cash fixed income. However, we have probably a little bit more in our model recommendations than we would be comfortable with. So we are actively completing research and debate on where to redeploy some of that cash. Will likely be in income-bearing opportunities of some sort, perhaps even call writing or other types of income-bearing opportunities in fixed income, for example. So that's the current weighting in our major asset classes. And lastly, I'll conclude by, all things considered, there's a ton going on. It's been a very active market, but we're still strongly adhering to our baseline philosophy I talked about, that we enter equity positions expecting to hold them for 3 to 5 or more years, maybe generationally hold them. And so we're not expecting, through even times of the most severe volatility, there are many holdings that we believe in and will ride out the storm and be robust for the long term. And so, that's where that patient long-term buy and hold investment philosophy carries the day. We are making adjustments at the margin. There's some great opportunities at the margin as volatility opens up price dislocations. So we are active, but we are not sort of fully turning over portfolios. We don't think that that's prudent. As long as the investment plan, that your risk profile, your goals, your liquidity profile is communicated and understood, and in conjunction with your Cambridge Trust team, we think that that's robust in terms of being globally diversified, asset class diversified for the long term. So with that said, I think I will hold further comments until Q&A and make sure I give some airtime here to my colleagues. Thank you, Jennifer, and over to you, Steve.
Great. Thanks, Dave. Yeah, I think what I'm going to do over the course of the next 10 to 15 minutes, both Dave and Jennifer alluded to, I'm going to talk about some of the things that our investment team, our group of analysts on both the fixed income and the equity side, have been seeing, hearing, talking about, especially as from a sector and company standpoint, now that roughly for the bulk of Q2 earnings are over. So Michelle, if you could go to the next slide. Wanted to start off with a quick recap of this stock market performance. Dave touched on this, but a couple more details. So you can see in the top chart, after a 20-month run-up that began in March of 2020, really at the COVID lows, the S&P has doubled since then. But at the beginning of this year, the market kind of started to digest the reality of rising inflation, rising rates, and the increasing probability of a recession here in the US and in other parts of the globe. And that really pushed the market down significantly. And that was a 20% move downward from January 1st to mid-June. But I will point out the S&P, including today, has rallied over 14% from that mid-June bottom, pretty much on deeply oversold conditions and a belief that maybe inflation has peaked, and we got some kind of wind of that today, and then really some underlying strength in the consumer as well. Next slide. So what have we actually learned from the second quarter from the companies that have reported? So far through the end of last week, 90% of the S&P 500's company have actually reported results. And overall, I'd say they were pretty decent. There was a little hint of caution mixed in there from many of the companies. But if you look at the green bars on this slide, that just shows that roughly 75% of the companies who reported actually posted positive earnings surprises. That's good in any environment today or 5 years ago. And by positive earnings surprise, they came in ahead in a good way of analyst estimates for their results. But if you dig a little bit deeper, the story gets maybe a little bit more murky. So average earnings growth, EPS growth for Q2 for the 90% of companies that have reported is up 7% year over year. That's great. But one thing that you have to adjust for and consider is the strength of the energy sector. So when you actually remove energy companies from that mix, EPS was down about 4% year over year. So energy companies, outsized strength there has been certainly a balloon under S&P 500 earnings. Next slide. So as a result, we've actually started to see corporate profit estimates from Wall Street analysts start to curl downward, ever so slightly for both 2022 and 2023. But even at these newly lowered levels, they're still expected to grow in kind of in the 8 to 9% year over year range, which, I think we hold the notion within the investment team that might be a little optimistic at this point. We expect earnings to come down a bit more at this point. Next slide. So, kind of backing up a little bit, what actually are the companies saying? How are they feeling? I'm going to take a closer look at three kind of important areas of the market that we pay pretty close attention to, and I certainly pay close attention to as the principal financial analyst for the financial sector here at Cambridge Trust. So first one is banks. It kind of goes without saying that banks are a very important pillar of the financial system, and we pay very close attention to anything and everything that the banks say. So first of all, overall second quarter results were, I call them okay. Some good, some not so good things. From the likes of what JP Morgan, Bank of America, PNC all talked about and reported. On the good side of the coin, lending activity was quite strong in the second quarter. And they closed, the banks in aggregate closed the quarter with accelerating loan growth, thanks to mostly strong demand from business customers who are working feverishly to replenish inventories that have been drawn down over the course of COVID and make some overdue improvements to their factories. But it's worth noting that all loan categories have been positive. But on the flip side, we are starting to see early signs of that loan growth, that growth in loans starting to moderate. Just this past week, the Federal Reserve Bank released their senior loan officer survey, which they do quarterly. And we've seen some, again, on the margin, nothing big, but some tightening in standards. So that usually is a precursor to slower loan growth in the coming quarters. Next slide. So as good as loans were, there's the other side of the coin for banks as well, coming out of the second quarter. So lending growth was great. Interest income related growth was great, but on the opposite side, the non-lending related revenues like capital markets, wealth management, mortgage servicing, they were all under pressure. And on this slide, I think it's just noteworthy is to point out the near 50% decline in investment banking fee revenue as M&A and IPO activity pretty much dried up in the quarter as business and investor confidence waned. Next slide. But among businesses and other groups, I look closely for signs of stress in their ability, and that comes in their ability to pay back and make their loan payments in a timely way as expected. So on this chart, I want to highlight the orange line. And this orange line shows the delinquency rates for commercial borrowers, for business borrowers at banks. And essentially that delinquency rate is whether that borrower is at least 30 days past due in making a scheduled loan payment. And you can see from the graph, the orange line, it's quite low. And it's close to historical lows at this point, as are most other loan categories, lending categories like mortgage borrowers, credit card delinquencies, and others. So right now, default risks, credit risks, sour loans risk, it's pretty benign at the moment. But again, continue to watch that. Next slide. And then just a very big picture look at bankruptcies among large companies. This slide stuck out to me just due to the magnitude of how low bankruptcies are running year to date versus last year and certainly versus prior years. So year to date, there through July, large companies that have gone into Chapter 11 are down 18% to 212, and versus 2021, and that's 37% below 2019 levels, so pre-COVID levels. So not a lot of stress on the business side of the economy yet. Next slide. And then the third area I just wanted to touch on was the consumer. And the consumer, after all, represents about 70% of GDP. And on this slide, you can see that consumer confidence is now at its lowest level, or at the end of June, was at the lowest level since the University of Michigan began collecting this data back in 1952. And that really has to do with concerns around inflation and high food and gas prices, which impact consumers directly. You know, one caveat here is, you know, that the number is tough, but when confidence has been this low, typically strong equity market returns have followed in the next 12 months. So, you know, we keep our eye on this kind of stuff as well as an indicator. Next slide. So, you know, I talked about the kind of the abnormally high rate of inflation persisting and weighing on consumer psyches. You know, and I will point out that just this morning, July CPI, the Consumer Price Index in July, was up 8.5% year over year, and that was a slight decline over the prior month. But you know, 8.5% rise in the CPI is pretty significant historically. That was led by a 13% jump in grocery prices, and gasoline prices at the pump are, as of today, or as of this morning, we're up 26% year over year. So again, these weigh on the lower income consumers and really inflict a lot of pain on their wallets. From the chart, you can see that the lowest income quintile spends a disproportionate amount of their disposable income, actually 94% to be exact, on, you know, essentials like food, gas, and shelter. And the companies that we have been following, that we follow, have been saying that they are certainly seeing pressure in lower income groups, some further along than others. Whether it's Walmart or Target, as Dave alluded to, those companies have seen sales of kind of these essential items. They've been decent, but at the expense of more discretionary items like clothing and lawn furniture, as Dave talked about. That's been, you know, left for dead for the most part. AT&T, the big phone telephony company, they noted that their lower income consumers have been slower in paying their monthly phone bills than is typical. And then even Shake Shack, which kind of skews more towards a higher income clientele, said that they have seen visits to their stores from lower income customers start to decline in July. So it certainly raises the question, is there a recession currently in a segment of the economy, the lower income segment? Potentially. Next slide. So I wanted to kind of even out my comments here on the consumer with a read across various consumer activities that are certainly worthwhile to note. First, in the box, the first box there, that is indicating that air travel has fully recovered, and the measure here is TSA security checkpoint traffic. So we are, according to TSA data, back to normal on air travel. But in boxes 2 and 3, these show New York City subway and bus ridership levels, and they remain pretty well below pre-pandemic levels, you know, roughly 40% below. And it's a sign of many things, but a sign that people are continuing to work from home, going into the office less frequently, and or they're shunning public transport. And then in the fourth box, this is going back to the restaurant dining data point. This is from OpenTable, and it tracks reservations that OpenTable transacts. And you can see that we are pretty much in a full recovery on restaurant dining, just like in air travel. In the fifth box, that's consumer spending, kind of same store sales data. that covers 80% or the equivalent of 80% of all US stores. And it's been really strong, certainly helped by inflation. And this is a dollar value that they're tracking. But there are transactions, helping to bump that number up as well. And then an interesting data point, this is in box number 6. This tracks credit or security card swipes at large office buildings nationally. And you can see they are well below normal levels, running at about 40% of normal pre-pandemic levels. Again, so people aren't going back into the office, aren't going into cities as frequently as they had been, for work purposes at least. Now that the pandemic is ebbing. So my final slide here is more a focus on the higher end. And as mixed as the data has been among the lower income groups, wealthier consumers have been spending pretty aggressively on almost everything. While this chart details the specific experience of credit card giant American Express in the second quarter, where they actually saw spending on their cards rise 31% on a year-over-year basis, heavily driven by travel and entertainment spending growth. Other businesses like Starbucks and Chipotle, both that skew toward higher income customers, have noted that there is ongoing strength in their businesses, and so indicating that there is strength in the higher end of the income stream. And then I think just to tie it all together, at the end of the day, there remains a good deal of mixed messaging in the data that we look at, which that's unlikely to abate. Some will improve, some data points will improve, some will get worse. But as inflation remains stubbornly high and the Fed remains on course to continue its tightening posture, there is an element of lower confidence in the economy right now. So we are watching, again, all the data points very closely, and that will wind it up for me.
Great, thank you, Steve and Dave, for that presentation, or those presentations, super helpful. And we have some questions, and again, for folks who are listening, please feel free to type your questions into the Q&A spot. So summarizing the question that is in front of us, it would be helpful if you could elaborate what was it in our outlook that triggered reducing equity weightings at this point?
Sure. So earnings outlook is not as certain as it formerly was. We think there's more to be reckoned with there. And so valuations have come down and compressed some. However, that is on the basis that earnings come through as expected in terms of the PE and related. And we're just not as confident that earnings are going to come through as expected if we face more trying and a longer, more prolonged Fed tightening cycle in order to break the back of inflation. That will have ripple effects through the consumer, through the jobs market, through various places that eventually are going to end up on somebody's corporate earnings being hit. As I said, though, it's a slight reduction in equities. It's a risk management maneuver, risk balancing maneuver, more than a running for the exits. For example, on an account that we might normally have it as a neutral at 60% equities, we're at 58%. So it's just a slight trim to our weightings. Rest assured, as we said, this volatility and then the net negative on the year to date has created opportunities that we're moving toward and leading into. We still have positive tracking error on the books, but we're just on a sort of beta and market level, tightening that up a little bit, and could be redeploying that elsewhere. But that's where we are currently.
Great.
I think that
Thank
covers
you.
it. Sure. Thanks.
Thanks, Dave. That's great. So Stieg, I'm curious, you cover a lot of sectors that have regulation. And so do you have any thoughts about the future of the regulatory environment on the companies that you follow?
Yeah, it's certainly not getting easier from events of the last couple months. First of all, with the Inflation Reduction Act that was passed through last week, two elements of that hit all companies. And there's the corporate minimum tax, and then there's the newly added 1% buyback tax. Roughly, we've seen estimates that could impact corporate earnings by about 2%, on the negative side. Companies may choose to offset this by, undertaking less research and development or less investment in property, plant, and equipment, things of that nature to manage the EPS hit. I think one thing that is a big question mark, certainly in the technology sector, over the last year, there's been increasing talk about more regulation and kind of breaking up the big tech conglomerates. And whether that would be good or bad remains to be seen, but I think we're only going to hear more about that. And then obviously near and dear to my heart with the banks, banks are always under the regulator's microscope. And about a month ago, the results of the most recent stress capital buffer analysis were released. And essentially that raised capital requirements for banks, which limits their ability to buy back shares, potentially to grow dividends at the rate that they would like to. So basically increases their capital levels. So there's a lot going on in the regulatory environment. We don't see it slowing down anytime soon.
Well, it's interesting when you talk about breaking up the big companies, that takes us back 40 plus years to breaking up Ma Bell. And, I guess it's kind of a sign that there's really nothing new under the sun. It just sort of goes around and around again. Maybe one last question for you, Dave. As you're thinking about asset allocation, what is your sense of potential next moves? If I could ask you to, you don't have to say we're going to do X by, raise this by 2%, but what are 2 or 3 things that you're thinking about?
Sure. Equity team is always sourcing and looking at new individual names. I won't necessarily talk about any specifics here, but on almost a weekly or certainly a monthly basis, there's 1 or 2 new ideas that our equity team is sourcing and bringing forward for approval and debate, trying to bump out and find a home in portfolios. So that's one avenue. We're watchful to international markets. We are overweight the US versus international. We've sort of been at the precipice of adding into that for a trend reversal. Have not done that yet. Strong US dollar and related things and the sort of flight to safety has kept the US outperforming. However, we think that will eventually be reversing. We're just not quite ready to do it yet, but it's on our watch list, particularly as you saw earlier in my charts. China has been through a bit more of a rocky ride than we have, and maybe on the way up and out eventually, or adding stimulus, if you will. And so that would probably add opportunity to all of probably the Asian region as much as emerging markets. That's one thing we're watching there. And then we're watching the bond markets. As I said, if credit spreads do widen, or potentially say bank loans fall in dollar price, and we can step in opportunistically, couple 3% type of thing on any of these suggestions we're talking about, that's something that's on the watch list and radar to add. And then we're always actively researching more unique kind of ideas to stay invested, but maybe in a in a unique or a hedge kind of way or income bearing sort of way. And so we've looked at things like a call writing fund. So we would have some equity beta, equity exposure, but would be in, giving off a little bit of the upside for a small portion in favor of income. And that would be particularly beneficial in like a sideways type of market where I think the return or the total return is going to be buoyed a lot more by income, dividends, yield to maturity and related in the coming months than outright, straight to the top price rally in stocks or bonds for that matter. So it's thinking around those components of total return and how we might get at them in unique ways. So we're always looking in that bucket as well.
Great, thank you. Thank you both, Stieg and Dave, for your comments. I think it was very, very helpful, and I hope our clients enjoyed this as well. If you do have further questions, please don't hesitate to reach out to your team at Cambridge Trust. We will post this recording and the slides to our website in the next couple of days. So we send our best wishes for a hopefully not as hot future summer, and we look forward to speaking with you either in client meetings or during our next conference call. Thank you so much.